All right. Well, hello and good afternoon, everybody. Time's now 4 p.m. Eastern, 1 p.m. Pacific. This is Tom Galucci, Vice President of Business Development with the Mortgage Collaborative, and want to thank everybody for joining today's TMC Connect web broadcast titled Insights and Analytics Tools to Navigate COVID-related Impact on Mortgage Market. And today's presentation or discussion is presented by our preferred partners over at Black Knight. I'm going to go through some quick housekeeping items as I see our attendees continuing to filter into the line. Sean, if you would do me a favor and advance the slide one for me. So first off, just want to encourage our attendees on the line to continue to check out our TMC Connect and member event calendar pages on the Mortgage Collaborative website. We're going to continue to update our TMC Connect broadcast schedule as we're getting great feedback from our members and partners within the network about the most pressing issues, facing all of our members' operations on a daily basis. So proud to announce we've got a total of 9 sessions queued up that we're hosting this week, and I encourage you to continue to check in as we're going to be continually adding new sessions for the weeks to come. So before jumping into today's discussion, just a couple brief housekeeping items. First off, whether you dialed into the call or you're connected directly via your computer, all lines have been muted for today's discussion. And this is done just to avoid any background noise in your area. So we want to ensure that all attendees can hear today's discussion clearly. We want these discussions to be as interactive as possible. So I encourage you, please feel free to submit questions for our discussion leaders throughout the call today. And we will go ahead and submit those to our discussion leaders at the end of today's discussion. How do you do that? Well, submissions for questions can be done either via the chat function or Q&A box, and both of which are accessible at the bottom menu of your Zoom screen. Now, keep in mind today's call will be recorded and will be available for playback. Instructions to access copy of the recording as well as copy of the presentation deck will be distributed to all attendees in a follow-up email that you should receive tomorrow. And if you could go ahead and advance the slide one more time for me. Thanks, sir. And so as far as today's discussion goes, we have the pleasure of having 2 experts from Black Knight lead our discussion. First and foremost is Director of Market Research and a regular CNBC contributor, Andy Walden. Hey, Andy, how are you?
Good, how are you doing?
Doing great. Thanks for joining us.
Absolutely.
And then also leading today's discussion from Black Knight is Managing Director of Origination Technology Sales, Sean Dugan. Hey, Sean.
Hey, Tom. Thanks for the opportunity. Good to speak to your members. Believe it or not, I actually am the gentleman on the right side of your screen, just with a lot more facial hair and a really bad haircut.
Oh, I love it. You got a good COVID look going.
Absolutely.
So, well, I appreciate, extremely grateful to both of you for taking the time out of your busy schedules to lead today's discussion for the benefit of our members here at TMC. And, Sean and Andy are both going to dive into the recent findings from Black Knight's COVID-related white paper, as well as touch on some timely analytics tools that our members can leverage during this time where there's right market uncertainty out there. So on that note, without further ado, I'm going to turn it over to Sean Dugan to kick things off. Sean, the floor is yours.
Thank you, Tom. Again, appreciate the opportunity, and hello to all the TMC members out there. So we're relatively new entries to the Mortgage Collaborative. That is with the exception of our Motivity Business Intelligence Group that has actually been a member for many years. But in the fall of 2019, we were very excited to engage with the Mortgage Collaborative. We participated in your fall event in 2019. And really, more than anything, we appreciate the opportunity to present what I believe you're going to find is very useful information around our findings on the COVID impact to the mortgage market and how to navigate the new normal. So given that we are new entries, I don't want to make any assumptions on whether or not you know who Black Knight is. I won't spend too much time on this slide, but I do want to tell you we are the premier provider from origination all the way through servicing the entire lending continuum, if you will. We've got over 50 years of experience and being organized in one way or another under different names over the years. We've got approximately 5,000 employees across our globe, and our corporate headquarters is in Jacksonville. You'll see some of the numbers on your screen. We're really comprised of three basic business units. One is our servicing division, which is delivers the MSP servicing, bankruptcy, and default platform. There's my division, which is the originations division, and that is our Empower Now loan origination system, which, by the way, we'll have a presentation at this same time next week. And then thirdly, we've got our data and analytics division, which is the leading source of mortgage and real estate specific data and advanced analytic products that is available in our industry. So I really had talked to Tom about how can we leverage the breadth and experience, as you see on your screen here, and the expertise of our Black Knight enterprise, so that the co-op can plan and respond to this pandemic that we're dealing with each and every day. And that's exactly why I asked Andy Walden to join me on today's call. So as you know, already the Director of Market Research at our DNA division, but if you're thinking, where do I know Andy from? You might recognize him from some of his recent spots on Good Morning America, CNBC's The Exchange with Kelly Evans, ABC's World News Tonight, and then CBS This Morning as well. So we've got no question expert here in our data and analytics division. And again, we'll speak specifically on our findings on the white paper we released in April, but also Andy is going to discuss some of the recent forbearance, refinance market outlooks, and some future-looking market trends. So Andy, I think I have teed you up, and we will go to the first slide.
All right, sounds good. Thanks, Sean. And I really kind of want to take this in a little bit of a three-part approach here over the next 20 to 25 minutes. The first will be, and Sean's kind of already touched on this a little bit, but what's the background on the data that's being used for this analysis? I think it's important to get an understanding of what data is being looked at when you start to look at research. Is it survey level data? Is it loan level data? What's the source of the data? So I want to touch on that quickly. And then I want to spend most of the time talking research findings over the last month to 2 months as we've started to dig into a lot of the Black Knight data assets. What have we seen taking shape in the market in terms of forbearance activity? What have we seen in the origination markets? What have we seen in the real estate markets as well? I'm going to try to cram quite a bit of research into about 20 to 25 minutes here. And then we'll talk forward looking. Where does the research go from here? What do we have queued up here over the next month or so? Because we do have a lot of data assets at our fingertips here at Black Knight, and we're, in terms of COVID-related research or COVID-specific research, I think we're kind of just scraping the tip of the iceberg with our analysis so far, and we'll be digging deeper and providing some initial insights here in coming weeks and months. So that's kind of the layout here for the next 20 to 25 minutes or so. If we start on this first slide with kind of background on the data we've been utilizing to analyze the market. And as Sean mentioned, a lot of people know Black Knight for our public records data, one of the largest aggregations of public records data in the market, or our MSP servicing platform, where about 70% of the mortgage market is serviced. Obviously, those are big pieces of the equation, and they certainly come into our COVID-related analysis as well. But there are a couple underlying data sets that we've really focused in on and really dug into in terms of COVID-related impacts. The first one is our McDash data set. I know it's got a little bit of a funny name for folks that haven't heard of our McDash set before, but effectively what that data set was, it was a conglomeration that was put together kind of during the mid-'80s of a lot of the bigger banks. And what they wanted to do was, they knew what their servicing book looked like, they knew how their mortgages were performing, but they really wanted to benchmark against the other big players in the market. So there were really the 5 big banks came together in the mid-'80s, came up with this. McDash stands for Mortgage Data and Statistical History, is what that stands for. And so they all started to contribute their data to one large mortgage servicing data set that they could then analyze, and we could then make commercially available to the market. It's grown significantly since then. Right now, we have about 50 different mortgage servicers that supply their data to Black Knight as part of this aggregation on a monthly basis. So the first day of every month, we start receiving files from 50 different servicers. About 30 million loans in total come through our doors on a monthly basis. And then we can look at all the underlying mortgage characteristics. It provides a lot of value, not only in looking at delinquencies, but a lot of additional value in mixing and matching that data with other Black Knight data sets. When we sat down in late March and started to look at how do we use this data to analyze COVID, what quickly became apparent was monthly data is no longer sufficient, right? Data that is available 15 days past month end. If we look at the COVID outbreak, most of the impact was in April. And so if you wait till April month end data is available, and then you wait for the 15 days to clean that data up and make it commercially available, we're to the middle of May, right? Effectively where we are right now, and we still haven't seen any actual data come out of the system. And so what we've done over the last 30 days is we've gone from that monthly data collection cadence to a daily cadence, which was kind of unheard of and even unheard of when we started doing it a month ago. But because we have that MSP servicing system, right? We have 70% of the mortgage market serviced on our software. And because we already have those contribution agreements in place with 50 roughly of the largest servicers in the country as well, instead of kind of burdening with those servicers with that ability to provide that data to us every day, we can then manually pull that data out of our system and load it over into our McDash database. And now we're collecting daily data and can look at mortgage performance on a daily basis rather than monthly basis. We're going to look at what that means and what we've seen from some of that daily reporting here in a little bit. Outside of that, and I guess let me touch on one more thing there. We also, and I think I may have mentioned this, but with that daily data, we then mix and kind of match with our public records data, with our API data as well, to gain some more valuable insights or additional insights that maybe those servicers can't do on their own as well. And we'll kind of talk through how we're using that a little bit ago as well. A couple of the other pieces that we look at, collateral analytics. So we just acquired collateral analytics. For folks that aren't familiar with them, they do a lot of different things around housing valuation, but one of the cool things that they do as it pertains to COVID-19 is that they are pulling down MLS data on a daily basis, and they are pulling down public records data on a daily basis. And their vision or their goal is kind of to create effectively a stock type picker for the housing market. You can see listing volumes, and you can see sale volumes, and you can see median prices on a daily basis in an extremely granular fashion, all the way down to the neighborhood level, and kind of look at your neighborhood and your home price in a stock type fashion and look at those ups and downs. And obviously always valuable, but extremely valuable in a housing market that's as volatile as what we're seeing with COVID-19 right now. So we'll look at some of the findings from that here in a little bit. Another one is our Compass Analytics software. So their evaluation, pipeline risk, hedging service is primarily what they do. But one of the cool things in terms of COVID-19 related analysis is they have not only the interest rates that are being offered to the market. You can get those a lot of different places. You can get them through Freddie, Mortgage News Daily. A number of different places have survey data that they publish in terms of 30-year fixed interest rates that are being offered to the market. But one of the interesting things about the Compass Analytics data that we're using is they have the secondary market rates, right? So what's the rate being offered to lenders? What are lenders then offering to the market? And what's the spread between those two? And I think when you look at those three in tandem, it tells a very interesting story in the market right now. And then the other things they have is rate lock data. So obviously the MBA publishes a lot of application data out there on a weekly basis. We're looking at it in a little different fashion. We look one step downstream to the loans that are actually locked in terms of interest rates. And then we can look at refinance rate lock volumes. We can look at purchase rate lock volumes. And we can look at the refinance incentives that should be sitting there and see how those compare and contrast. And we'll look at some of those findings here in a little bit to look at how COVID's been impacting not only rate offerings from lenders, but how it's been impacting homeowners and home buyers in the market as well. And then last one here quickly, Paragon MLS. So that's an MLS search engine that we own here at Black Knight as well. One of the cool things as it relates to COVID-19 is daily online real estate searches by home buyers. You can look at foot traffic numbers elsewhere, and we'll pull some of those into the presentation just so we can look at them side by side as well, because I think they tell an interesting story in tandem. But the online real estate searches tell an interesting story just because they aren't as heavily impacted by shelter in place, right? So even if you're sheltered in place, even if you're home, you still have a computer, you still have the internet, you still could be searching for real estate if you wanted to. And so it starts to help you narrow down the impact of shelter in place versus just kind of overall economic impact and suppression on the demand side of the equation. We'll look at all three of those or all four of those as we kind of move throughout the presentation. Sean, if you want to skip to the next slide here, we'll talk white paper for just a second. So one of the things that we were tasked with early on, kind of late March and early April as we were getting early into COVID-19, was really looking holistically at the interest rate, origination, mortgage servicing, kind of mortgage performance, real estate markets, and kind of putting an overarching white paper together of all of the different impacts of COVID-19 on those markets across the board. And I'm not going to get overly into this. It's about a 20-page white paper, but we will send out the link to download this white paper. For folks that really want to get into the weeds there and read through that white paper, we'll send you the link, and you can kind of dig through that at your leisure. But it is something that we've put out there using those same data sets that we've talked about before, and pulling in our modeling team and pulling in some of that historical observations of mortgage performance. We've kind of modeled some forward looks and things like that that are out there. So for folks that are interested, again, we'll send you that link and you can go out there and download that research piece. Sean, if we skip to the next one there. So one of the first pieces that we put out in terms of actuals research around COVID-19 related impacts is what we call our Forbearance Tracker. So we're taking that daily data collection, being pulled from our MSP servicing system, being loaded into what we call McDash Flash, which the Flash is just daily, right? Our daily mortgage performance observations. And we started to put out what we called a Forbearance Tracker. And the intent behind this was really that Black Knight is really one of the few, and in fact, the only company that has the capability, both in terms of the servicing platform and the contribution agreements with servicers, to be able to look at this forbearance data on a daily basis at a loan level basis as well. And so we wanted to be able to put this out there. There were a lot of conversations going on, especially in early April, around liquidity of servicers, forecasting forbearance volumes. And so we put this out there really to help inform a lot of those discussions and to have those discussions with a lot of the government agencies that were coming to us for information. We put this publication out there to kind of track those forbearance volumes on a daily basis, and then look at the underlying liquidity challenges as well and put a number behind that. So how many forbearance loans are there out there in the market? What's the P&I on those loans? If we're looking at servicer advances, what's the dollar amount of advance requirements, and what kind of liquidity structure needed to be put in place at the government level? So we started to publish this Forbearance Tracker out there. We're continuing to do that on a weekly basis. So we're doing it each Friday. I've put our blog link down there on the bottom left for folks that are really interested in tracking that. You can go out there to that blog each Friday and pull down the most recent numbers. The numbers that we're looking at here today are as of last Friday, so May 8th. I think they were pulled on May 7th, the day before that, and then published on May 8th. When you start to look holistically at what those numbers are telling us, I think the most telling numbers are kind of on the top right side there, the total forbearance volume. So loans in COVID-related forbearance, they're about 4.1 million right now as of last week. The forbearance rate is 7.7%. So 7.7% of all active first lien mortgages are in forbearance as of the end of the first week of May. All right, so to put that in context a little bit, 4 million loans in forbearance. So if we look at the Great Recession of 2009, effectively what that 4 million tells me, at least, is that if you look over the first 3 years, from effectively 2006-07 through 2009-10, it took us 3 years to see the first 4 million homeowners become stressed to the point of delinquency during the Great Recession. We've seen that in effectively a month and a half during the COVID outbreak. So a very massive uptick in pressure when it comes to delinquency and forbearance activity out there in the market. When we start to look across that chart from right to left, so moving away from the totals and starting to look at the individual breakdowns, probably the most telling pieces to me, if you look at FHA VA, right? We kind of lumped those together when we built the report because we were looking at it from an investor standpoint. If you look at Ginnie Mae as a whole, that FHA VA combination, about 11% of those loans are in forbearance right now. A little bit misleading, and I hate to say that because I created the report, but if you break those two apart, effectively what you see is that FHA is closer to 13-14% forbearance rate, and VA is closer to 7%. So roughly twice the take-up rate in terms of forbearance activity among those FHA loans. Probably not surprising to anybody on this call, right? They're more your first-time home buyers. They're your home buyers that had less of a down payment, less residuals as well. but that's where you're seeing a lot of the forbearance stress and a lot of the potential delinquency and default stress in the market right now is in that FHA space. If we broke that other category down in a little bit more detail, right, that one's kind of your primary or your portfolio held loans, your legacy private label securitization loans. Effectively, you would see the same thing. The private label securities, those loans that we all have talked about from the Great Recession, you look at those loans that are still sitting out there, it's still about 13 to 14% of those loans are in forbearance. So they're performing from a forbearance and stress standpoint very similar to what your FHA VA book is looking like. And then again, noticeably lower forbearance rates among your portfolio held loans. And if you look at Fannie Freddie, I think the story is a little bit different, right? Lower forbearance rates there, a lower share of homeowners in Fannie Freddie loans are taking up forbearance. You're still talking about over 6% and 1.8 million, but the take-up rate's a little bit lower there. But when you look at overall volumes and stress and dollar amount of advances required from servicers, that Fannie Freddie book is a significant population there. You're talking 1.8 million loans in forbearance. And if we look at the bottom portion of that chart, when we start to get into the P&I component, and you kind of walk through there. So you look at your average monthly payment, and then the third line there is the total aggregate. So if you look kind of at the third line, bottom chart over on the right side, you see 64.9 billion. That's effectively, if you look at total monthly mortgage payments in the first lien mortgage market, all across the board, there's about $65 billion in P&I payments made each month by homeowners. About 31 billion of that comes from Fannie Freddie. Well, if you take that haircut, right, the 6.5%, 6.4%, that are in forbearance, what you see is about $2 billion worth of P&I payments that are not being made on GSE loans right now. And so from a liquidity standpoint, if you look at what servicers are being required to do, what that effectively means is when homeowners aren't making that $2 billion in payment, servicers are on the hook for that. And the FHFA has recently come out with guidelines that require servicers to advance the first 4 months of P&I. Do the math there, $2 billion times 4 months of advances on those loans is $8 billion of P&I advances over the next 4 months needed on those GSE loans. So we're talking some pretty significant dollar amounts from a liquidity standpoint. And obviously that's where a lot of the conversations have been recently. Sean, if we switch to the next slide, I think obviously the two questions are where are we and where are we going, right? And so that tracker that we just looked at gives you a good idea of where we are, at least as of last week. The next question is, what do we see from this point forward? If we've seen roughly 4 million forbearance cases in roughly a month and a half, what happens over the next month and a half as well? And so here on this next slide, we're taking that daily McDash Flash observations, and the next kind of interesting thing is you can then look at forbearance activity every day and kind of look at daily trends. Where are we kind of heading over the last, or where have we headed over the last couple of weeks? And the good news here, when we start to look at those daily increases in forbearance activity, is that they've run off pretty steadily over the last month. Right? We've seen noticeable declines, and that's even through early May. And really, when you look at some of the forecasts that are out there in the market, I think a lot of folks I think the big unknown was, what does May look like and what do June look like? Right? Do we see the bulk of the forbearance activity up front, or do we see pretty consistent forbearance activity where you kind of see a wave in early April when payments come due, and then we get to May and you see the kind of a secondary wave, and then maybe a bigger wave in June as some of folks' savings burns off? We've seen almost the opposite so far, right? And I think we'll learn and understand more about this as we observe for another couple of weeks to see if there is any kind of resurgence as we get close to the late payment date for May. But so far, we haven't seen any semblance of a resurgence in May. It seems so far that folks really got into those forbearance plans in late March, got into them in early April, and then the volumes in terms of daily inflow have started to run off a little bit over the last few weeks. And on the right side, effectively all we're doing there is taking a momentum-based approach, right? So if we continue to see kind of that rundown in forbearance inflow that we have seen, that bottom dotted line is kind of where we end up in that 4.5 to 5 million range, which I think is pretty optimistic given that we're above 4 million already, right? So I think that's a positive sign of potential for the market. But then if we see April repeat itself, you get up into that kind of 7.5 million-ish range as well. And again, we're kind of looking at these on a daily basis. When we get through the end of this week, I think we'll have a little bit better idea, and you'll start to see those optimistic, pessimistic lines starting to tighten in around where we're likely headed here over the next couple of weeks. All that being said, right, when we look at mortgage performance, I think there's some interesting insights gleaned so far. I think a lot of the More interesting research is going to come over the next few weeks, right? We're going to get into more of a geographic type analysis. You're seeing certainly variations across the country. Centered around the Northeast is where you're seeing the highest forbearance rates right now, but you're certainly seeing pockets in different areas across the country. So I think there's a geographic component that certainly comes into play. And then that equity component that we talked about earlier as well. So one thing that we're in process of doing right now is taking that daily forbearance data, matching it with public records to pull down any second liens that have been taken out on those mortgages since origination, and then matching that to home price index information as well, and kind of gleaning an overall equity picture, or a mark-to-market equity picture of each one of these loans and forbearance as well. Because I think what we're going to see when we start to get into the performance phase of the discussion, right now it's a volume discussion. When we start to get into the performance discussion, it's going to be, how do FHA loans perform differently, from a forbearance standpoint to GSE loans and portfolio loans and legacy private label securitization? And I think a big component of that is, what's the equity position of the homeowner? If I have a cash flow issue, right? I lost my job, I don't have monthly income to make my mortgage payment, but I have significant equity in my property, I'm not really a loss risk, right? Or a default or foreclosure risk. I'm a short-term liquidity risk for the market, but you won't see those likely play out to nearly the degree as somebody that's underwater on their home and then lost their job, or has less than 10% equity and lost their job. And so that's some of the analysis that we're putting together right now is, what does the equity landscape look like for these forbearance loans? Of the 4 million, how many have significant equity that probably aren't a loss risk? How many are either underwater or near underwater that could be a little bit more of a risk? And I think you'll see that varies quite a bit by investor category as well. Sean, if we go to the next slide there and get into the origination market a little bit. And again, this data is coming from our Compass Analytics team. The top left chart here, we're looking at interest rates. So green line is the primary rate being offered, your conventional 30-year average note rate being offered to homeowners from lenders. The lighter blue line there, that FNCL rate, effectively what that is a secondary market rate. So what rate is being offered to lenders? And then the darker blue line is the spread between the two. And if you look at what's really happened here so far in 2020, I think there are a couple different underlying stories. And I'm sure, talking to kind of an origination group here, I'm sure everybody's well aware of what's been going on, but we'll recap using this data just for fun here. But effectively what we see is that light blue line, so your secondary market rate, along with your primary market rate, kind of were falling throughout early 2020, hit record lows in early March. And that's really when things started to get shaken up. When you started to see the stock market fall, when you started to see unemployment rise, and that jump. So effectively we went from record low 30-year rates in early March, and you saw rates jump from 3.25% up to 4% effectively overnight. Right? And if you look at the underlying drivers, it was primarily driven, and there was a little bit of a spread increase there, primarily driven by the secondary market, right? Folks got spooked from the secondary markets. There was this influx of uncertainty. You also had rates hitting record lows, and so people that were investing in mortgages had all of this attrition risk that just entered their portfolio, and everybody kind of pumped the brakes on investing in new mortgages, and you saw those secondary market rates rise, right? So when you look kind of early March through mid-March, it was really a secondary market issue that was pushing those 30-year rate offerings to the market up. Following that, you saw the Fed step in with their QE efforts and kind of settle those secondary market rates. There were some bounces in between, but by roughly late March, you started to see those secondary market rates come down as the Fed started to inject money through QE into those secondary market purchases. That being said, the secondary market rates fell pretty noticeably, but the rates being offered in terms of to homeowners or refinancers in the market remained relatively high, because from that point forward, lenders started to build their pad on top of what was being offered to them. So you saw the spread between secondary market rates and primary market rate offerings jump by a little over 0.5% during that time frame. And there are a number of reasons behind that. I think there were a lot of hedging issues that took place during that time. Originators were getting hit. But there was also a lot of uncertainty and just massive rises in unemployment. And so lenders weren't sure. One, they had a full pipeline from early March, and we'll look at that, or we'll see that when we get into our rate lock numbers. Right, so you had full pipelines. You were trying to transition your entire team to work from home. You had this massive wave of unemployment that hit the market as well, and you weren't sure if a loan that you were originating today was going to close in 30 days, and if that borrower was going to be, or the potential borrower was going to be employed when you went to sell that loan as well. And so there were all of these risk overlays, there were all these interest rate overlays that still persist in the market, even if we look as of last week, right? So May 5th, you were still seeing those significant spread increases from secondary market rates to rates that are being offered to the primary market as well. So that's kind of what we're seeing from an interest rate perspective. Now, if you start to see that the market normalize a little bit and you start to see those spreads normalize a little bit, I think there's a lot of potential for refinance activity out there. On the top right here, effectively what we're doing is taking that McDash data, right? We know how many active mortgages there are out there. We know what their credit scores are, their equity positions are. We know what their interest rates are. And so what we can do is look at kind of a spray of interest rate environments and calculate what refinance incentive would be under every interest rate environment that you can kind of throw at the system. And so that's what the top right is looking at, is under each one of those interest rate scenarios, how many refinance candidates would there be out there in the market? And if you start to see, and call us in that 3.25% range right now, right? So roughly 14 million, somewhere between 12 and 14 million refinance candidates out there right now, already somewhat near a record high. If you saw interest rates drop as little as 1/4 point, there'd be 19 million refinance candidates out there. Those are homeowners that have 720 plus credit scores, 20% equity in their home, and they could save 0.75% through refinance. And you're talking roughly 40% of the first lien market falling in that category. So certainly a potential for massive refinance activity out there if that took place. But then if we transition down and look at lock data, what that lock data is telling us is that borrowers aren't as reactive as they were a month to a month and a half ago to those interest rate incentives, right? So I think that's an interesting component of the story as well. I'm looking at the bottom left chart here, and our green line is interest rates, our blue line is 7-day lock averages. What you saw was in early March, when rates got down in that 3.25%, 3.375% range, whichever interest rate metric you're looking at, you saw just this massive wave of rate lock activity, right? Everybody, when everybody had their job and rates dropped down to 3.25% roughly, you just saw a wave of refinance activity hit the market. And that's really kind of what seized up some of those originators and caused some of those hedging issues as well as you got later in the month. Well, then you kind of look at what's happened to 30-year rates since then. They jumped, but they've come back down. And if you look at, say, April 14th, 30-year rates were roughly equivalent to where they were in early March, and you didn't see any kind of reaction in terms of refinance rate locks. Folks didn't jump out there and take advantage of refinances and apply and lock in rates like they did early in March. Now, we've seen it come back a little bit, but broadly what that tells me is that your homeowners aren't reacting to interest rates and refinance incentive like they were in the past. Now, partially maybe because they're sheltering in place, and they have their eyes on 100 different things, including homeschooling their children and whatever else is going on in their lives right now. But you're not seeing that activity. And the second component, obviously, is job loss as well. And we've seen unemployment climb up to roughly 15%, likely going higher from there as well. So there's that component. But I think that creates some challenges for the market in understanding your attrition risk as a servicer, in forecasting refinance origination volumes, and valuing MSRs, and on down the line, right? It creates a lot of challenges when you look at an interest rate environment that you know how the market reacted a month ago, and now the market's reacting differently today. And I think you can, in terms of analysis and understanding that, if you effectively take your top right chart, right, and look at refinance incentive, and then you look at lock rates and run a percentage out and run pull-through rates on a daily basis. Historically, you do that on a monthly basis, but now you either need to do it on a daily or weekly basis. Then you can start to really analyze that underlying trend. All right, how are borrowers reacting? Is it softening a little bit over the last couple of weeks? Are we seeing less of a pull down in refi reaction to what we should see in terms of interest rates, and kind of map that trend in the future? So certainly something that we've begun to do already, but something from an origination standpoint that I think is going to be extremely important going forward. And then on the bottom right side, purchase lending activity and purchase lock activity. You can certainly see the impacts of COVID there as well. And obviously a little bit of seasonality in that purchase market, much more so than what you would see in the refinance market. But it's pretty clear when you get into kind of April, you can see that pullback in purchase lock activity. You can see kind of late February, early March too, when those rates dropped, it kind of caused a surge of folks locking in those purchase loans as well. But overarchingly speaking, if you look at April, locks were down about 25% on average from where they were in March. And obviously that has impacts on purchase lending volumes, especially when you kind of roll forward 30 days and look at May closings, likely to see a noticeable seasonal pullback, or not seasonal, COVID related pullback in purchase closings when we get into May. The good news there is you've started to see that come back over the last roughly week to 2 weeks. You've started to see those purchase locks reemerge a little bit. Perhaps too early to call it a trend, but you have seen over that last week of April, first week of May, you've started to see a little bit of a rebound in purchase related locks. And then Sean, if we go to the next slide there and talk housing market here for a little bit. And again, we're pulling in a number of different data sources here to kind of compare and contrast. The left side here, effectively, we're looking at the demand side of the equation. The top left chart is looking at in-person foot traffic. We're pulling this from a company called Showing Time that handles a lot of those real estate in-person showing data. And then the bottom left is coming from our Paragon. So that's online real estate searches as well. And you see a similar trend, right? The online is a little bit less severe, even though it doesn't look like it here. It's about a 25% pullback roughly in online real estate searches. On the in-person, roughly a 60% pullback is where we bottomed out year over year. We're now back to about 40% as of the third week of April compared to where we were a year ago. But the good news on the demand side is you're starting to see that rebound a little bit as well. And again, this is late April data. If you roll that forward another week, you start to see even more of a rebound. You are starting to see in-person foot traffic come back. You are starting to see online searches come back on the demand side as well. And what I think the top left chart shows that's interesting is we saw a wide array of outcomes by geography, depending on whether real estate was exempt from an exempt business line during shutdowns, and how hard folks were sheltering in place as well. I'm here in Colorado, and we were one of the areas that locked down real estate more than most, and so you saw roughly a 90% decline in foot traffic year over year in Colorado. But then we've started to open up over the last week, and you've started to noticeably see those Colorado numbers begin to rebound. Texas, not quite as locked down. So in terms of year over year declines in foot traffic, you're seeing a much lower degree in Texas. Now, how that plays out over the long run, right? Especially if we start looking at secondary waves of COVID-19, certainly some potential impacts there as well. But certainly expect to see geographic differences really across the board in terms of forbearance take-up rates, in terms of real estate haircuts or declines in seasonal activity. I think you're going to see a lot of variety across the country, depending on how folks responded to COVID-19 from a shelter-in-place perspective. On the right side, top right, and I think this is probably my primary takeaway from this, is that demand has rebounded faster than supply, at least so far, right? Supply is at least on a week to 2 week lag in terms of recovery. Similar haircuts, so in-person foot traffic down about 60%, new listings down about 70% year over year when you look at kind of where they fell to at the bottom. So similar declines, but again, if you look at the left, you can start to see the rebound. If you look at the top right, new real estate listings, we haven't quite seen that rebounded listing volume yet, which could be a blessing in disguise, right? If you see demand return a little bit more quickly than supply, maybe that helps to sustain home prices in kind of an uncertain price environment to some degree as well. And then our bottom right chart there, we're looking at our collateral analytics data, and we're looking at median price of new listings in green versus median price of new sales. And what this tells the story of is kind of the lag of traditional housing market data. So traditional housing market data shows median prices on sale activity. And when you look at that, it actually paints a fairly good picture. You continue to see the median price on sales rise throughout mid-April at least. And that's really driven by contracts that were put in place in early March when interest rates were low. So you were still seeing home prices and contracts bid up based on the low interest rate environment. But if you look at new listings, you started to see prices level off and even fall a little bit. And I think there are a couple different reasons for that. One is if you look at the shelter-in-place requirements, you're seeing them more heavily in your more urban areas, which are your more expensive areas. So that's part of the reason that you've seen median list prices at a national level come down a little bit. But the other piece is that I think folks selling their home right now know that they're selling it in a suboptimal environment. And so they're being a little bit more aggressive in how they're listing their home. And you're starting to see some of those prices come down. And that could suggest some softening home price on the sales side here over the next couple of months. So certainly something to keep an eye on. And I think that's when we start to look at kind of the value of data sets and which data sets to keep an eye on, that's really why I like that collateral analytics data set, kind of that daily tracking of home sale activity, listing activity, price activity. It gives you almost a real-time look at what's going on in the housing market, which I think is very cool. And then lastly here, if you want to flip to the next slide there, Sean, if we talk about the look forward, right, and where do we go from here? We put on webinars on a monthly basis. So for folks that are interested in this type of research, you're certainly welcome to kind of reach out to us and join in on those monthly conversations. You can email us at mortgage.monitor@bkfs.com if you'd like to get involved with more of these kind of monthly analysis, see some of that research. From this point forward, I think our big focus, especially around April, is going to be kind of aggregating that delinquency data with the forbearance data, because you're seeing a lot of mix and match behavior. You would think that forbearances and delinquencies would have a strong overlap, but you're seeing folks enter into forbearance that maybe made their April mortgage payments. You're seeing people that missed their April mortgage payment that maybe haven't entered into forbearance. And so we'll be comparing and contrasting those trends to a larger degree. And then we're going to get a lot more granular with that analysis, like I was talking about earlier. Geographic granularity, equity granularity, performance of forbearances, expiration dates of forbearances. When could we see those numbers decline? And what's the forward look at how these forbearances could perform? So we'll be doing a lot of that type of research along with updates on our housing market and origination as well. And again, we have those weekly forbearance trackers that we're putting out there for folks that want to keep an eye on those. You can find those at our blog at the link below as well. So with that, I'll pass it back over to you, Sean.
Thanks, Andy. Super informative, Tom. I think we wanted to open up for any questions that the team may have for either Andy or myself.
Absolutely, and thank you both, Andy in particular, for going through those different data sets as to what you're analyzing, your team's analyzing at Black Knight. I get a lot of value in joining those monthly Mortgage Monitor discussions, and I'm sure our members who like to geek out on some of the metrics and trends out there that Black Knight's providing. I definitely encourage registering for those upcoming discussions as well. To Sean's point, this is the opportunity for our attendees. Any questions that you have, please feel free to filter those through either the chat or Q&A function, and I'll be able to present those out to both Sean and Andy. Real briefly, while given an opportunity for some of those questions to be queued up, I do want to remind our attendees, as Sean alluded to at the beginning of the conversation, he will be coming back to join us same time, same date, next Tuesday. Is going to get into a discussion around some key differentiators for driving ROI through Black Knight's Power Now platform. So we will have a link to register for that discussion as part of the follow-up to today's call. So absolutely encourage our attendees to register and join us next week.
Yeah, and so just a note on that. So I think one of the takeaways from Andy's data, right, is I think the acceleration of some of these cycles, how quickly all this is happening, it's in hyper speed. And when you hear technology providers talk about scalability, usually there's a discussion of scaling up. And I think you need to keep in mind that maybe it's closer to elasticity. So scaling up and scaling back as needed. And what is the greatest cost in accomplishing that? It's people. So the presentation next week is going to be a little bit different in that it's not a life cycle of the loan presentation. We're going to focus in on 6 key capabilities that the Empower Now platform has that we fundamentally believe you will not see anywhere else in the industry. And it's all to drive the optimization and efficiency of the loan origination system. And just one key metric, the number of loans per full-time employee across the industry deviates from 5.6 to 5.7. Using the tools that I'm talking about, we have a number of lenders that are seeing triple that, right? So 15 or more loans per full-time employee. Full disclosure, not all our clients, but absolutely multiple clients. We're going to key in on what those 6 key capabilities are. We're going to talk about what makes them different. We're going to talk about what the benefits are and what your return on an investment might be in utilizing those. If you like what you see during that presentation, the concept is you'd engage with TMC. We would set up a one-on-one discovery discussion, and then we would provide a full cradle-to-grave LOS presentation specific to the TMC members' needs. So just wanted to kind of articulate what the scope of next week's presentation will be. Thanks, Tom.
No, thank you, Sean, for going through that. Got a couple questions come in so far here. So, Andy, going back to the McDash daily data sets that you referenced at the beginning of the discussion, you know, as far as being able to push out those metrics on a daily basis as opposed to monthly, is the information the same in that data set of analytics, or does it have to be slimmed down just from a mechanical standpoint to be able to push that out daily?
That's a good question. It is slimmed down a little bit. So for McDash monthly, we have about 112 different data characteristics that we pull down, from origination to performance to investor categories and cuts and cohorts. We slim it down to about 40 for that daily cut, just to speed up the process a little bit. But what we've also done is match those daily data observations to our monthly data observations as well, especially for those static fields. So you still get the full power of the 110 plus data fields that we have in the monthly file, just through that matching algorithm that we have in place already, but we speed up the ingest process with a little bit slimmer data set on the daily fields that you really care about, your delinquency, your forbearance start dates, your expirations, all of that's done on a daily basis. Some of the more static type of things that don't change throughout the month, we don't ingest that on a daily basis, but we do match to it to get the same power.
Gotcha. Appreciate that, Andy. And then another question here. So a lot of our members are very much focused when looking forward, trying to analyze, you know, what may be coming down the line as far as potential first payment defaults amongst their newly originated loans. You know, and the Black Knight data set of different metrics that you're analyzing, is there, you know, any in particular that you might point to as far as trying to, you know, read through the tea leaves, I guess in trying to forecast what, you know, some of those metrics may look at in the coming months as far as, you know, sort of first payment default?
Yeah, and I haven't looked at defaults specifically. A lot of the questions that we've gotten are from the MBA and the Fannie and Freddie on what share of newly originated loans are in forbearance within the first month to 2 months. Mm-hmm. Certainly that you can do all of those types of analysis with this data set. So you have origination in May, so as soon as that data is loaded into your servicing system, it's then being pulled over, and you can look at forbearance rates all the way down to the daily level. And I was actually doing some of that analysis over the past couple of days and just looking at forbearance rates on loans that were originated last week and loans that were originated last month. And you can break it down again by purchase refi. I know there's a lot of focus on cash outs. So we've been looking into some of that activity as well on recently originated cash out refis that are now in forbearance. So all of those types of metrics and analysis can be done through McDash Live.
Appreciate that insight. Just want to remind our attendees, last call here as we're getting close to the top of the hour. For any questions that may have for either Andy or Sean, please feel free to submit those via the chat or Q&A function, and I will queue those up for you. Another one I have here offhand, you know, went through a lot of different data sets, you know, that you and Black Knight are analyzing on a daily basis, and you may have covered this, but you know, any particular trends amongst those data metrics that stand out that might provide some hints as to, you know, where we're heading as an industry in relation to, you know, upward or kind of leveling off trends along the lines of new forbearance requests?
And I think the ones that we walked through are in terms of trajectory, I think those are the most important to me. What's our new daily inflow volume? But again, I think the next question is, how do these forbearances perform? Right? Even if you have a 5% failure rate, on these forbearances, you're talking about a significant number of homeowners that potentially could be facing default on their mortgages. And so I think that's the next question. We've done some of that analysis on historical natural disaster events. So following hurricanes, how do those homes perform, or how do those mortgages perform, and what's the rebound look like there? I think there are a number of different reasons why this is much different than a natural disaster. And so that's some of the pieces that we're going to be looking into. We'll be looking into that equity component that we talked about earlier. How much equity do those folks have? I think that's going to be a large driver of downstream success. But again, with that daily data, you can look at forbearance expirations. And what we see is that servicers are primarily setting them up as either 1 to 3 month forbearances. And the CARES Act sets it up as a 6 month if requested, and another 6 months if requested again. You're seeing servicers play them in smaller windows, right? They would still give those homeowners the 6 and 12 months if required, but you're seeing them set up shorter touch points on those mortgages. And so I think over the next 1 to 3 months, we're going to get an idea of how many of those forbearances could potentially come off early. Do those volumes start to pull down? And then what are those roll rates and what are those performances look like?
Yeah, you ended up answering another question I might have there. So, no, that's great insights. I think we're all very active and interested to see what those trends look like, to your point, as those initial forbearance requests, hit that 3 month window, what percentage get extended out, and, we'll get back on our recurring payment schedule. I think you'll see a lot of eyes and ears towards what the metrics hold coming.
Absolutely. Yep.
Excellent. And before we wrap up here, I do want to remind our attendees as well, as part of the follow-up to today's discussion, we will also be sharing a downloadable link to Black Knight's recent COVID-19 related white paper. As Andy and Sean both mentioned, that really dives a lot deeper, I think about 20 pages into the pandemic impact on the mortgage and real estate market. So be on the lookout for that as well. And then Sean, Andy, before we wrap up, any closing remarks you'd like to share?
Sean, I'll let you go first, and then, I'll go.
Yeah, I would definitely take advantage of the white paper. There is quite a bit of really impactful information there. It's a very informative read, so please do take advantage of that. Outside of that, hope to see as many of you as possible on next week's presentation. Again, whatever we can do to better inform and support the Mortgage Collaborative, please let us know. We'll work with Tom to make sure we're leveraging the full breadth of our enterprise so that you're informed and as best positioned as possible. So thank you for the opportunity, Tom.
Yep. The only thing I would add on top of that is if you have questions, and I know we all kind of the mortgage market is huge and the real estate market are huge, and I know we all look at it in a little bit different light and from a different lens. And so if there are questions that you're trying to answer or things that you would like to know, feel free to shoot them over, even if they're kind of a rough kind of starting point of a conversation. Feel free to shoot those over, because that's kind of how we typically start our research, is just it starts with questions, right? What is it going to look like here over the next 3 months? What is the success rate probably going to look like? And same goes for the origination side as well. So if you even have those questions or topics, or you want to continue the discussion elsewhere, let us know and we can pick it up.
Agreed.
That's a great point, Andy, and reiterate that to our members too. Please leverage us at the Mortgage Collaborative as well as Black Knight as a resource. To Andy's point, it's based off of feedback from lenders and your teams in the trenches. Starting the conversation or the inquiry, which help derive additional metrics or additional insights that can be then shared back out to the mortgage community as a whole. Excellent. Well, gentlemen, I want to thank you both again for taking the time out to the valuable insights that shared with us today, and also want to thank each attendee that came to join today's discussion. Not lost on us how frantically busy everybody is right now in the environment, so truly appreciate spending some time with us today. And on that note, Andy, Sean, I thank you again and hope you both stay well. And to everybody on the line, thanks for joining and enjoy the rest of your day.
Thanks everybody. See you guys.
Thank you.